Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. India's central bank on Monday announced a mechanism to settle international trade in rupee. The move will definitely make trade easier with Russia and some other countries which are facing US sanctions. Our next report tells more about the Reserve Bank of India's decision and its likely impact.
In February last year, the RBI had said that the emergence of the Indian rupee as an international currency was inevitable. According to the central bank, internationalization will lower the transaction costs of cross-border trade by mitigating exchange rate risk, but can also complicate the conduct of monetary policy. As yet, the rupee is not a freely convertible currency. Internationalization refers to the phenomenon of a national currency trading beyond its borders and actively used in the invoicing of trade and financial transactions, commodities, and foreign exchange reserves. And last week, SBI Group Chief Economist Soumyakanti Ghosh said in a research note that the RBI should make a conscious effort to internationalize the rupee, and the payment disruptions caused by the Russia-Ukraine war offers a good opportunity to insist on export settlement in rupee, beginning with some of the smaller export partners. And on Monday, in a step that can help take the rupee global, the central bank unveiled a mechanism for international trade settlements in rupees at market-determined exchange rates. RBI's move means that Indian importers can now make payments in the rupee, which will be credited to the special Vostro account of the correspondent bank of the partner country, while Indian exporters will be paid from the balances in the designated Vostro accounts. A Vostro account is an account maintained in rupees by a local bank for a foreign bank. The surplus rupee balance in Vostro accounts can be used for investments in government securities, payments for projects and investments, and for export-import advance flow management. Russia's war and the subsequent economic sanctions from the West, such as blocking some Russian banks from the SWIFT financial messaging system, may have prompted the RBI to take this step. Experts believe this might be aimed at facilitating easier trade with neighbors, particularly sanctions hit Russia and forex-starved Sri Lanka.
So yesterday's circular actually has the potential to eventually internationalize rupee, but it's that particular route is a long road away. In the immediate future, though, there are some countries that might be interested, particularly starting with Russia. So if you have $2.5–3 billion of trade deficit every month with Russia, it used to be much smaller than that 3–4 months ago. And remember, Russia is looking for currencies to hold its reserves in. Rupee could be a potential currency for it, even though it's not a hard currency, because India is a friendly regime for Russia. Because this circular now allows the Russians and the Russian banks to invest those money into India, it earns some money on the reserves as well. From an India perspective, also it works like a charm, because this is a time when our current account deficit is threatening to cross $100 billion. Of that, if $2.5–3 billion per month actually is paid not as dollars but as rupees into an account sitting with our own banks to be deployed into Indian assets, including Indian government bonds, that's beautiful. I'm guessing here that Russia will be okay, but it's still a geopolitical decision that has to be taken both at Russia's end. We will likely face geopolitical challenges globally. Then you have to go through the operational issues of actually opening accounts. Chances are the larger Indian banks would not want to open Russian bank accounts. In the current form, this is not going to be very attractive for normal countries. It's a one-way street. If you have rupees lying in your banking system in India, you can't take it out in the form of hard currency whenever you want. The other suggestion that's been made is that maybe countries like Sri Lanka might be interested. Again, that's fundamentally a little difficult to understand how that will work. See, this works where a country has a current account surplus with India, which means they're exporting more into India than importing, right? So which means you're left with rupee balances. Sri Lanka imports more from us than exports. So how do you generate rupees in the first place to pay us, right?
India imported oil worth $5.1 billion in the 3 months to May from Russia, more than 5 times the value a year ago. In fact, Russia has become India's second biggest oil supplier, replacing Saudi Arabia. Barclays chief India economist Rahul Bajoria said this mechanism can be particularly useful for neighboring countries. India's trade with its neighbors and Russia stood at $169 billion in FY22, accounting for 16.4% of the country's total trade volume. The mechanism can also come in handy for trade with certain African and South American countries facing severe forex shortages. Exporters, meanwhile, are seeking clarification on whether incentives applicable on exports where the payment is received in freely convertible currencies like the US dollar will be available in the rupee settlement mechanism too.
See, there are several countries with which India can have the rupee denominated trade. One is, of course, the countries which are under sanctions. I don't think the US will really have much of a problem. With the neighbors, I'm not too sure whether Bangladesh will be willing to do it. Nepal, of course, there shouldn't be a problem at all. So really, it is up to India's diplomatic skills to get countries on board.
With Russia unable to access its foreign currency reserves, trade settlement in rupees can emerge as a win-win deal for both the countries as India ramps up its purchases of crude oil from the sanctions-hit nation. As for other countries, India's diplomatic relations will determine whether they can be persuaded to adopt this medium for trade settlement.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Russian invasion of Ukraine is in a way prompting countries to look beyond the US dollar for trade. Similarly, the war may accelerate the case for moving away from fossil fuel too, feels Nicholas Stern, professor of economics at the London School of Economics. He spoke to Business Standard's Asit Ranjan Mishra on wide-ranging issues, including the focus areas and reforms that India should undertake to become a developed economy. Let us listen in.
What do you think should be the priority areas and the key focus areas for reforms for India to become a developed economy?
I do think that the whole environment for investment is very important. We know that India has grown the fastest when it's invested strongly. And so investment, particularly private investment, is center stage. So I would focus the first part of an answer to that question on the conditions for investment and how confident people are in getting things done and realizing the returns from their investment. I think the clarity of the tax system is another one. And I do think the GST is a very important step in a good direction. So building on that as the basis of taxation. We absolutely do need taxation. Indeed, India needs to increase the share of revenue of taxation in GDP. It's probably 3 or 4% points below where you'd expect a country of that income per capita being. But it now has the tools to do that. But it's important to use them in a simple way, transparent way, so it doesn't complicate people's lives too much.
So how do you see and how do you rate India's climate actions towards building a green economy and its intention to achieve net zero by 2070?
If you look back, I've been to all the COPs since 2006, and I've been coming to India since with great cheerfulness and pleasure since 1974. And I think if you look at the Paris Agreement, India was very important in that. Prime Minister Modi was very active in those discussions, and we would not have got a Paris Agreement without the intervention of India, and more than the intervention of India, the enthusiastic participation of India, and that came from, had to, like other countries, had to come to the top. The Glasgow Agreement, which was the next big one, really, last November, Prime Minister Modi's speech setting out this new path for India, setting out his Panchamrit, which included net zero by 2070, but also a lot of actions. The other four were 2030. I think that's very important. So I think India has been a real participant in this story.
After India's promises at COP26, you had said India's annual emissions of greenhouse gases could peak by 2030 in your statement. Do you think that is still achievable?
I think I said could, that it will be, you know, it will not be easy, but I think that's a useful target. India is not committed to that, but I think it's one that you have in mind. It won't be easy, you know, given the existing structure of energy supply and given the strong growth that we hope will be there in India. But, you know, India's exceeded targets, you know, in these last years. Its growth of renewables has been faster than anticipated. So I think it's worth thinking in those terms. But I don't want to pretend it's easy to do.
Do you support, there is now a proposal in the EU to put a carbon tax on imports. Do you support that kind of measures?
The carbon border adjustment mechanism. I think that a limited form has some logic. There are some energy intensive trade exposed sectors. And steel is an obvious example, aluminum, cement to some extent, although cement's so heavy you don't move it about so much. So in some focus sectors, there is an argument that if you're pushing very hard inside your own country, and particularly European Union, that is an example, an important example, that they're pushing very hard, they've got quite a high carbon tax, that, or in this case, trading scheme price, to take into account those internal policies when those goods are being imported. And I think they will move in that direction. But it's very important to keep it transparent so that it's not a mechanism for protectionism. That's very important. And for similar reasons, to keep it focused on just the very few industries where it matters. So there's a logic there. But at the same time, because it's those particular industries, what we need is collaboration to decarbonize those industries. So if we're talking about steel, we would like to see, or we should as a world, get together to see how we can move towards green steel. And we're moving quite quickly, actually. That would be all countries getting together around that, in this case, through the steel sector. So I think it has a logic in a limited area. I think it will come. But it's very important to follow the logic and keep it transparent, keep it simple, keep it focused, and keep it away from protectionism. And at the same time, collaborate within those industries, and particularly, as we discussed earlier, going back to what we were discussing earlier, for the richer countries to come up with finance to help that transition.
क्या हाल?
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Meanwhile, moving on to markets, mid and small cap indices have outperformed their large cap peers in July so far. So what is attracting investors to these two market segments, and will this outperformance last? Here is a quick check.
This far in July, the mid and small caps have outperformed their larger peers amid volatility. The S&P BSE Mid Cap Index has gained around 5% thus far in the current month, while the S&P BSE Small Cap Index has surged around 4.5%. In comparison, the S&P BSE Sensex has moved up just 2% during this period. The overall surge in markets, analysts said, is mostly on account of a fall in commodity prices, especially crude oil, offering some respite to the adverse macros. Global bond yields too have moderated by 20 to 50 basis points from the recent highs, and earnings estimates for the Nifty haven't seen any worthwhile cuts. All this is supporting the market sentiment for now, said analysts at Motilal Oswal Securities. Valuations for the Nifty have moderated to 18.7 times FY23 EPS, in line with its long period averages. The glass appears half full to us, delicately balancing the headwinds with some silver linings. The dominant factor influencing markets, according to VK Vijay Kumar, Chief Investment Strategist at Geojit Financial Services, is the sustained rise in the dollar that had gained momentum during the last 1 month. Dollar has appreciated 5% since early June and 13% so far in 2022. If this trend sustains, it is bad news for EMs. But for now, it appears that this flight to dollar safety is a bit overdone and due for some correction. G. Chokalingam, founder and Chief Investment Officer at Economist Research, expects this choppy phase for the markets to continue for the next 2 to 3 months.
First of all, why they have done well was due to two reasons. One, the inflow of retail investors, new investors, continued throughout July. Surprisingly, despite the market meltdown, on a weekly basis, every week 4 lakh investors have come in, approximately around 16 lakh investors, and their preferred choice is always small cap. The second reason, as we all know, most small cap stocks have corrected anywhere from 30 to 50%. So that has become an attractive point for these new investors, and also for the existing investors who got trapped to average it down. So these are the two reasons for outperformance in July. Now coming to the question whether it would continue going ahead, possible, may not be possible, but don't want to confuse. The clear view is that another 2-3 months it is going to be a little difficult for the whole market, because Fed balance sheet reduction already started at a rate of 47.5 billion per month, and in September it is going to be 95 billion per month, which means Rupee will continue to fall, which means FAI may continue to take out, or at least they will not bring the money back quickly. Possibility of taking out is more. So the whole market will be little volatile with downside possibility. So that could give nervousness to the retail investors. So therefore, one should play cautiously. Instead of tilting towards a small cap or tilting towards large cap, one can play a balanced, allocation between large and small cap, at least for next 2-3 months.
So, what should your shopping list in this segment look like? While analysts at Motilal Oswal Securities remain bullish on these 8 stocks from the mid and small cap universe that include Jubilant FoodWorks, Macrotech Developers, Lemon Tree, and Ashok Leyland, here are some suggestions from Edelweiss Securities, Whirlpool, PVR, Blue Dart, Varun Beverages, PI Industries, Trent. On Wednesday, the sentiment will be impacted by inflation numbers released post-market hours on Tuesday. Stock-specific action will continue as companies announce their Q1 FY23 numbers.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
When stock markets undergo correction, most investors turn towards the exit route, thinking that they would re-enter when it is all over. This phenomenon is called market timing. Experts don't recommend it as no one manages to pull it off consistently over a period of time. Our next report offers some tips to mutual fund investors.
Usually, stock market recoveries tend to be sudden and sharp. If you have exited your equity funds, you will be left on the sidelines. By the time you re-enter, it will be too late and your returns will lag behind that of the market. A better way to handle stock market corrections is to stay invested, especially if the money you have put in equity funds is not needed for the next 5 or 7 years. Don't stop your systematic investment plans or SIPs during a market correction. Each installment of the money invested will buy a higher number of units during a downturn. This will boost returns over the long term. Make sure your portfolio is well diversified. In addition to equities, it should also hold debt and gold funds. Having uncorrelated assets in your portfolio will reduce the hit you suffer. Gold typically does well when equities are underperforming, and bond funds do well when the central bank starts cutting interest rates in response to an economic or market downturn. Within the equity portfolio, make sure you have exposure to international funds as well. Different geographies perform in different calendar years. Developed market equities, in particular, tend to have a low correlation with the Indian market. The quantum of downturn suffered by different markets also varies, and that too will cushion the hit to your portfolio. Your portfolio should also have exposure to different styles of funds. Typically, growth funds tend to do better in bullish conditions, while value-oriented funds do a better job of protecting downside risk. Next, check your exposure to mid and small cap funds. Typically, these funds outperform during a bull market and also decline heavily during a downturn. While you should have exposure to them to garner the alpha they are capable of generating, it should be limited. 70% to large caps, 20% to mid caps, and 10% to small caps is a good exposure for retail investors with moderate risk appetite. Finally, ensure that your exposure to sector and thematic funds is limited. Exposure to a single sector or thematic fund should not exceed 5% of your equity portfolio. Cumulative exposure to all sector and thematic funds should not exceed 10 to 15% of the equity portfolio.
I will achieve, I will fly high.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
According to reports, mutual fund houses added 5.1 million investor accounts in June quarter. That's all for today. For more news and analysis, please log into our website www.businessstandard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.